one quick follow-up on companies wherein the earnings disappointments and rich valuations leave room for downside in an otherwise buoyant market.
Yeah. So I think some of these sectors, Neeraj, like specialty chemicals, where expectations are very elevated, right? Given variety of macro factors which are in favor of them, China plus one, the big capex that they have done. But, the prices have run up ahead of the fundamentals. So there can be some cool off that can happen in that space, I believe. But, it's
and
very...
even earnings could be an issue.
Earnings can be an issue because they are standing on a very high base, but earnings can fluctuate a lot, as we have discovered in the last 3 quarters. They have so far surprised on last 2 quarters, where we were expecting margins to take a big knockdown, but at an aggregate level, they've done well. Like I mentioned, they reported a 17% profit growth this quarter. We were expecting the quarter to be flattish, but valuations are a bit rich there. And any downside surprise can, have a disproportionate impact on the stock. So because the expectations are very elevated there. Then by and large, I don't think other sectors are trading at an obnoxiously expensive valuations.
Okay.
Consumer has always traded at a rich valuation, so no difference there. They always trade rich for a variety of reasons. Then you have, so if you look at index itself, Neeraj, Nifty at about 18 times, 18.5 times. Look at FY 24,000 rupee EPS. If you look at FY 23, it is somewhere about 20-21 times. So it is not cheap, but at the same time, it is not very expensive either, I would say. It's in a fair value zone. So the expectations on near-term returns have to be very moderate now. Unless something happens globally on the commodity side, or your yields come up significantly and lend extra support to the equity valuations. But mid-cap is still trading at an expensive valuation. If you look at the NSE mid-cap 100 index, it's trading at somewhere about 21p, so which is at a 10 to 15% premium to Nifty. What has gone into discount in the last 1 year is NSE small cap. So this was trading at a 20% premium a year and a half back when small cap stocks were rallying. Now at 15 times, so it is at a discount to Nifty. And small cap, in fact, if you take a step back and even evaluate the performance of the small cap index versus the previous cyclical peak of December 2017, then for 5 years almost, it has done nothing, right? So you can obviously look at different starting points and make a case. Starts of March 20, you would say it's up 3x, but from December 17 to December 22 almost, 5 years is given very flattish kind of performance. So it depends where you stand and which index you look at. Valuations obviously are never an absolute game.